A company that millions of American students once relied on to survive finals week is now fighting to stay listed on the New York Stock Exchange. Chegg, the online learning company behind homework help, textbook rentals, and study tools, just received an official warning from the NYSE. And this isn't the first time in the last year. So what exactly happened? Why is this a big deal? And what happens if Chegg can't fix it? Let's break it down. On the 24th of July 2026, Chegg announced it had been notified by the New York Stock Exchange that the company is not in compliance with one of the exchange's core listing rules, Section 802, 1C of the NYSE Listed Company Manual. Here's what that rule actually says. A company's stock has to maintain an average closing price of at least $1 over any 30 consecutive trading days. Chegg's stock failed to meet that bar for the 30 trading day period, ending the 23rd of July 2026. In plain English, Chegg's stock has been trading so low for so long that the exchange had to step in and issue a formal compliance notice. Here's the part that makes this story even more significant. This is not Chegg's first warning. Chegg already received a similar notice from the NYSE back in December 2025 for the exact same issue, falling below that $1 minimum price requirement. At the time, Chegg managed to turn things around. By the end of May 2026, the company had cured that violation and regained full compliance with NYSE standards. But now, just 2 months later, Chegg is right back in the same position out of compliance and starting the clock all over again. That pattern is the real story here. It suggests Chegg's stock isn't just having a bad month, it's struggling to stay stable above that dollar threshold at all. So, what happens next? The NYSE doesn't delist a company immediately for something like this. Chegg has been given a 6-month cure period to fix the problem. Here's exactly how Chegg can regain compliance. On the last trading day of any calendar month during that 6-month window, 2 things need to be true at the same time. First, Chegg's stock needs to close at a price of at least $1. And second, the average closing price over the trailing 30 trading days also needs to be at least $1. If Chegg hits both of those numbers on the last day of any month within the cure period, it's back in good standing, no delisting. Chegg has also confirmed it plans to formally notify the NYSE of its intent to fix this. And this is important. The company said that plan may include a reverse stock split if the board of directors approves one. For anyone unfamiliar with that term, a reverse stock split doesn't add real value to a company. It simply reduces the number of shares outstanding and multiplies the price per share by the same ratio. For example, in a 1-for-1 reverse split, $10 of stock at $1 each becomes 1 share worth $10. It's a mathematical fix to satisfy exchange rules, not a sign the underlying business has improved. Now, before anyone panics, this notice does not mean Chegg stock stops trading today. Chegg's shares remain listed and continue to trade normally on the NYSE throughout the entire 6-month cure period, as long as the company continues to meet all the exchange's other listing requirements. The real risk only kicks in if Chegg fails to regain compliance by the end of that 6-month window. If that happens, the company's stock would then become subject to the NYSE's formal suspension and delisting procedures, meaning it could eventually be removed from the exchange altogether and pushed onto over-the-counter markets, which are far less visible to everyday investors. To really understand why this is happening, you have to zoom out. Chegg built its entire business on being the go-to place for students to get step-by-step homework help and study support online. But over the past couple of years, free AI tools have completely changed that game. Students can now get instant explanations, practice problems, and study help directly from AI chatbots for free, without ever needing a Chegg subscription. That shift has hit Chegg's subscriber numbers and revenue hard, and Wall Street has been reflecting that pressure in the stock price for a while now. This NYSE notice isn't really the root problem. It's a symptom of a company trying to figure out how it stays relevant in a world where AI can do a big chunk of what it used to charge students for. Chegg has said publicly that it's leaning into AI-driven personalized learning tools of its own and shifting focus toward workforce skilling training and upskilling for adult professionals, not just college students. Whether that pivot works fast enough to turn the stock price around is really the question investors are watching. So here's what to actually keep an eye on going forward. Every month, for the next 6 months, watch whether Chegg's stock closes above $1 on the final trading day, with a 3-0-day average also above $1. That's the exact benchmark that determines whether this story resolves quietly or turns into a much bigger one. Also, watch for any announcement about a reverse stock split. If Chegg's board approves one, that will likely be the company's chosen path to satisfy the NYSE quickly, rather than waiting and hoping the market price recovers on its own. Chegg was once one of the most recognizable names in student life across America. Now it's fighting just to stay listed on the exchange, where it's traded for over a decade. We'll be tracking this story every step of the way, so if you want the update the moment Chegg's next move happens, make sure you're subscribed to Stateline Report. Drop a comment. Do you think Chegg can turn this around? Or is this the beginning of the end? Let us know below. Thanks for watching. We'll see you in the next one.